Good morning. This is Nick Stern. I'm a certified financial planner with Robert L. Stern Financial Services here in Amherst, Massachusetts. So first, happy 2018. 2017 was a really good year for a lot of different reasons. Here, definitely because of the financial markets, it was pretty good to most investors on the long side. I know it's been pretty chilly, so I hope you had a really nice holiday or holidays, and hopefully it'll warm up soon. It's ridiculously cold here in the Northeast. So anyway, what I wanted to do for the next couple topic discussions is do really an investor series. I'll name it Investments 101. And I just want to go over some things where maybe you're a current investor and you're looking things up online, but it's so much information it can be hard to make sense of, and doesn't make sense to use this or use that. We had talked about fundamental or technical analysis late in 2017, but this is really a refresher, some things that hopefully you can take away, you can find value in, and overall just making sense of all the information available out there that will help you hopefully become, at least at the very least, a more knowledgeable investor, if not a more or a better investor. So what I wanted to start off with today for today's topic discussion for January 2018 is really the markets. What are the markets? What are the financial markets? What does that mean? I'm sure that you've heard it here and there. I certainly say it a lot, talking to clients, friends on these videos. And I'll just say this. What I'm referring to are the main financial indexes like the Standard & Poor's 500, the Dow Jones Industrial Average, the NASDAQ, the Russell 1000, 2000, Wilshire, overseas, etc. Usually, when I am personally referring to the market, I'm just saying as a broad base, not necessarily the overall, not necessarily a specific index, but basically a combination of all indexes. So, for example, if I were to use it into this statement that says, the markets were up today, I'm referring to, in general, the main indices. Typically on the domestic side, meaning here located in the U.S., I'm referring to the main or general. The indices were positive or are positive today. And there's a lot of different things that people can refer to as far as the markets and the different indices. And some people, probably older generation, maybe they're referring to more the Dow. Newer or middle, maybe Generation X is referring to the S&P 500, or maybe a combination of that. I would say a really popular index that people tend to refer to is probably the Standard & Poor's 500 index. It's, in my opinion, a better gauge of the overall markets because there's 500 companies in there versus, for example, the Dow, which only has 30. The Dow Jones Industrial Average. So that's really what people are referring to. Now, taking that away, what would be a good one to watch? Well, I would say all of them. If you want, let's say if you own a combination of many different stocks and companies, and they range from large to small to international, or you own some mutual funds, etc., that's all represented, but it's not necessarily are represented in a specific index. If you look at something like the Russell 2000, that has a lot more companies than the S&P 500, and more importantly, it also represents companies that are not just mega capitalization. That means really big companies, or your otherwise known as blue chip stocks. It represents both mid and small. So you're going to get a better collection of how the overall markets are doing, including small and mid cap. Now, generally, the Russell 2000 is less representative of overseas because a lot of mid and small cap companies really don't do that much business overseas. That's really reserved for the larger or mega cap companies. So I would say that if you want to look at an index like that, just you can Google any index that's represented overseas, or you can do the Europe Stock Exchange or the China Stock Exchange or Japan or what have you. And FYI, I'm not saying one is better than the other. I'm just providing examples of what indexes that you could watch to give you a good representation of both domestic and international markets. What's the purpose of using these? Why would I want to watch it? So overall, it really refers to individual equities or securities, i.e. stocks. So if a good way to track performance, for example, is if you own you own stock X, and stock X is listed on the Standard & Poor's 500 index. We're going to refer to it going forward as S&P 500 for short. And you want to know basically whether or not it was a good investment. One of which, you can tell if you're going to be positive on the year. That's, of course, a positive takeaway, meaning you most likely made money. But how does it compare to the rest of the market? You could look at the S&P 500. So if your individual stock, if stock X did better than the S&P 500, considering that's where it's listed, I would say that overall, for that time period, it was a positive investment because you beat the overall index. Similar on the other side, where let's say you own the same stock X or stock Y, for example, and it did less than the S&P 500. It doesn't mean the investment's not good. It just means that it underperformed the index, and in that particular time period, you would, of course, done better in the S&P, meaning owning a collection of stocks versus just one. And I would argue that depending on your risk tolerance and depending on your overall goals and how investments fit into your personal situation, and I say this as a generalization without knowing anything about you, and of course you want to do your own research or consult your financial advisor, but overall, when you look at the long-term nature of an individual company or companies, there might be different growth potential than the overall index, which is why somebody would opt to buy a few or a small basket of individual securities versus owning the overall index. So people can refer to that, or when people say, for example, that they're invested in the market, it could mean that they're just invested in a mutual fund that basically tracks and performs the exact same way as whatever index that mutual fund follows, versus if they own individual stocks, it's going to perform differently most likely, and of course there's different results and also different risk features to that investment. And those are some things that I'll get into more of as we go through this. Just so some underlying reasons as to why first we kind of talked about what the markets are, and really they're just referring to specific indexes or indices depending on where you are, what you want to track, why you'd want to track it, really to know how your investments perform versus the overall markets. And it is important that you choose the right basket or right index, because you want to be as apples to apples as possible. That will give you a good gauge of actually how it went. For example, you can't really compare somebody who throws a lot of touchdowns with someone who hits a lot of home runs. Two different sports, can't really get an accurate comparison. Similar where if whatever investment or investment baskets that you own, you want to make sure that you're comparing it to the same reason. So that would be why, one, you want to choose it, and two, you want to choose the right one to give you an idea of what it is. As far as owning an index versus not owning an index, actively managed versus passively managed, that's really up to you. It goes into what your risk tolerance, obviously it falls in line with own personal views and beliefs. And I would just urge you to do your own research and really look at and understand the risks of both. And when you're talking to your friends, one, maybe it's a conversation starter and you'll just be a bit more knowledgeable so that you can, speak a little bit more comfortably about what you're doing versus what somebody else is doing. And I say that only because there's so much information out there, and it's not that that's bad, but being able to tie it together to help you be a better investor is probably the most important, and something that can really help you now in particular, but also over the long term. So anyway, thanks for tuning in. I really appreciate it. Next couple months, again, we're going to be talking about really Investments 101. This was just an overview of what the markets are and what it means and why to look, and hopefully you found some helpful things in there. So anyway, thanks again. Happy New Year, and I'll see you next month.